All right. So the whole point of this seminar is that we want to dispel some rumors and answer some questions about basically what in the hell is the underwriter doing to my income. I have been doing this a very, very long time. I can tell you there are an infinite number of ways to calculate out income. And so if you're a realtor on this call, this is great for you to know about the what your borrowers need to know or are going to go through. And obviously for borrowers, it's really going to be good to know about what counts as income, what doesn't count as income, and how can you take some proactive steps before you get into contract to make sure that everything lines up. So we're going to go through it pretty quickly. Obviously, let me know if you have any questions, but this is all about income. So without further ado, the income, what does this mean? Okay, so the idea about income is anything that is derived from work or earnings. So that would include pay stubs from your job, any bonus income or commission income on your tax returns. If you have a lot of money and you're earning dividend income or interest income. There's also retirement income. So a lot of people now retire, they're getting Social Security or they're getting pensions or VA benefits. Disability benefits would count. So for instance, if you have a permanent disability from the state or the federal government, and then there's something called IHSS, that is for in-home health and services. And basically that's going to be income for you paying that you get paid for from the state for caring for elderly or handicapped adults or parents. There's also foster income. So anything where you actually have to work for that money. Okay, that's going to be earned income, and that is income that we can use so long as we can show that it's stable, reliable, and it's permanent. So what would be things that are not income? So what's not income are going to be things that wouldn't be there that are, again, remember the idea is stable and consistent and essentially permanent. So gifts from a borrower or from family members are not income. Loans are not income. So sometimes people take out a large loan or a business loan and they want to use that as money coming in. So I'm trying to differentiate between income and deposits. Okay. Car and auto sales. If you sell a Volkswagen bus for 40 grand, that is not earned income. That is a one-time sales transaction. It is likely not going to continue. And so it wouldn't be used for income. Car and meal allowances are going to be very rarely built into an employment contract that you would use for income. Temporary disability, because it's not permanent. Those are all items that are not income. And then I put in capital letters, non-taxable or not taxable income. So those side businesses that you have, the $100,000 that you earn on eBay, if it is not on your tax returns, it is not taxable. So I should have said on the first slide, one other source of income would be rental income. Or if you have other business income that shows up on your taxes, we can use it as a continuing source of income. So how do you get paid? Depending on how you get paid, it's going to change the way in which your income is calculated. So for a wage earner, that's anyone, that's me, I'm on 100% commission, but I actually receive a pay stub and a W-2. So anyone who works at a regular job that gets paid, 40 to 50 hours a week and receives a W-2 is going to be considered a wage earner. Typically, you are paid hourly or you are paid salary. So there's a concept of what's called an exempt or a non-exempt employee. So a non-exempt employee is someone who is going to get paid for working over 40 hours a week, basically an hourly employee. Okay, so for every hour you work, you get paid. If you work more than 40 hours a week, there's state rules that say you have to get paid overtime or going into a double time and or holiday pay. It's going to be a little bit different because it's all based on the hour that you work. A salaried employee is going to be someone who works at a corporation. A great example would be all of your state workers. State workers are salaried. They could work 40 hours a week. They could work 35. They could work 45. They're still only getting paid that set amount over that set period of time, irregardless of the hours that they work. Okay, so those are wage earners. Typically, salary borrowers, no problems with income, very, very easy to calculate. You just take what their semi-monthly or their bi-weekly income is, you calculate it out over a 12-month period, and you divide by 12, and then that's going to be their monthly gross salary that we would use. Overtime, double time, those type of incomes need to be average. So going back to the original concept that everyone needs to remember is income needs to be stable and reliable. So if you have someone that has overtime, we need to be able to show that they've had a 2-year history. Now, without getting into the weeds here, sometimes people change jobs. If it's in the same line of work, right? You work for an HVAC company and you earn overtime, and then you work for a new HVAC company and you're still earning overtime. There's a bit of a different averaging, but we can use that. So we need to have a 2-year history of earning overtime, commissions, bonuses. The reason why it's a 2-year minimum is because, one, that shows a consistent history of that income, plus your bonuses or your overtime is not going to be consistent each year. So again, we take an average of it because you don't want to get in a situation where the next year the overtime goes down and now all of a sudden they don't qualify for the loan. So there's going to be some averaging that takes part on anyone who is a hourly employee, and then we're building in overtime, double time, commissions and bonuses and the like. Okay, so that's one form that you can get paid. Self-employed borrowers, very tough normally, and now extremely problematic with COVID. Normally, you need to have a self-employed borrower would be any of your business owners. So business owners would file a Schedule C on their taxes. So if you're a realtor, you're most likely a Schedule C, or perhaps you've incorporated, but most tend to be Schedule C. It's your basic sole proprietor. Someone owns a painting company, is in business with himself, really doesn't have a big operation. They're going to be a sole proprietorship, and they're going to file all of their income on a Schedule C on their personal tax returns. Then there's something that the other thing that we run into would be an S Corp. S stands for, I think it's small corporation. So it's for anyone that has less than 35 shareholders. And an S Corp is going to be a small business. Here's where the question starts to come up on an S Corp. And typically people who own an S Corp will also pay themselves a salary. That doesn't mean that your salary and the W-2 you pay yourself makes you not self-employed. If you own more than 25% of the income, more than 25% of the business, then you are technically self-employed for lending purposes. And that means that you are going to be put into the self-employed category of how we calculate that income. So I had one client who was just arguing with me until the very, very end that she didn't own her own business. She was a W-2 of her own business, but all of her tax paperwork showed that she actually had a 50% ownership. So we have to go through some steps to show that that income is going to be consistent. Okay, so that's a self-employed borrower. Anyone who receives 1099 income. So anyone who is receiving a service, so a realtor, anyone on this call would be great too. Your 1099, you're going to get a check from your brokerage every year of what your income is, and you're responsible for paying your own taxes. So when you're responsible for paying your own income taxes, that means that you're going to be considered self-employed. And the rule again would be a 2-year average of your self-employment income. So let's talk a little bit more in depth about self-employed income, because it is such a deal killer on so many different occasions. So first of all, as a self-employed borrower, you can only use your taxable income. So your CPA will kill your income. What the CPA does with your taxes to get your income low to avoid taxes means that you are going to also get wiped out on your income for your mortgage purposes, okay? Because the way income works for mortgages is that you can only get credit for the income which you actually report and you pay taxes on. So I'll give you a perfect example. Self-employed borrower has $800,000 worth of gross above the line revenue, and then they start deducting everything. And by the time it's all whittled down and depreciation and mileage and cost of goods sold and all that kind of stuff, their taxable income is $50,000. And they say, well, I have a really good accountant. I made $800,000. Well, no, you didn't. You grossed it, but then you have costs. And by the time it was all deducted out, your taxable income is 50 grand. That is all the income that can be used. So I always tell borrowers that are using taxable income from their tax returns because they're self-employed, please send me your tax returns before they're filed. And I will tell you what the last 2 years worth of income is going to be with those tax returns. So you know going in what you're going to be able to qualify for. Once those returns are filed, you really don't want to get into amending them. You can run into a situation where you start getting audited. Okay, so it's only what you show as your taxable income. So your adjusted net income would be on the Schedule C. It's going to be the very bottom, adjusted net income. Then we get some paper losses added back in: depreciation, depletion, business use of home, mileage. Those are paper losses that we would add back in to build back up that income. But we really need to work with CPAs and just know going in that, you know, a lot of self-employed borrowers don't like to pay taxes. Well, you're either going to pay taxes or you're not going to have very much income to qualify for a loan. Okay, so we really got to watch the deductions. That's going to wipe out the income that's usable. Any S corp, so your or LLC. So again, going back to those who have an S corp, you're going to pay yourself a W-2. That's all the income that we can use as your salaried income. And then on top of that, you may have some distribution. So you can see underneath where I have S corp, I've identified you're going to pay yourself a salary, and then any of the distributions you took, right? When you get those year-end bonuses and you write yourself a check for 20 grand from the business, that would show up as a distribution, and it's on Form K-1 from your corporate taxes. So that's why you're getting the request to get not only your personal returns, but also your corporate returns, because we have to match up that K-1. And that is absolutely usable income that can be used. So if you leave all the money in your business and you don't take a distribution, then it's not money we can use because it's not going to be taxable to you on your tax returns. Okay. Now, here's the kicker that makes income such a total pain in the butt for self-employed borrowers. Because we're in this pandemic and there's no way of getting around that your business was shut down for a little bit, the new COVID rules are that we need to supply a P&L and a balance sheet and now 3 months business bank statements. 3 months business bank statements are going to prove that what you're showing on your balance sheet and your P&L matches the business revenue that's coming in, because people can do whatever they want on their P&L and their balance sheet, but once we show that the business revenue is actually coming in, we can match that up, and that's going to be the income calculation for, my guess is, at least 2021 and beyond, until the numbers come up and everyone knows that businesses are back up. Okay, so self-employed income, very tough, no shortcuts. You have to have people really dive in deep and identify what their income is, and work with the lender and the underwriter to show that their information is accurate and that the revenue is actually coming in. Okay, so how do those gosh darn underwriters calculate income? Okay, so the general rule is, depending on the loan, you can't have too much of your income going towards the housing payment as well as the debts. Okay, so these are some very, very high level criteria of how an underwriter is required to look at and calculate income. So the income, like I said earlier, needs to be stable and it needs to be reliable. So someone who works at Intel for the last 5 years and earns a salary, that's stable, reliable, easy. I once had a borrower who worked in the spring and summer as a river raft guide, and then took a couple of months off during the fall, and then worked on and off as a ski instructor. Very, very tough. It's variable income. It's not stable and reliable, and that was a tough loan to get through. So we want to have some consistency. We don't want someone to work at Starbucks for a while and then find out that they go to Europe for 6 weeks and then they come back and they work somewhere else and they're bouncing around. What happens is that the question of whether that borrower is going to make that payment starts to rise in the mind of the underwriter, and you're going to have problems. So income's got to be stable and reliable. So again, salary income, same income every pay period, easy to calculate. Hourly at 40 hours, same 40 hours every pay period. That's like an administrative assistant, easy to calculate. You can see over a period of time, they always work 40 hours, super easy. Variable income. Now that's going to be someone who's working hours vary per pay period. Sometimes they work more than 40, sometimes they don't. A perfect example of variable income is a nurse. A nurse will work regular hours, then they have overtime, they have holiday, they have night shift, they have what's called shift differential, which is like a crossing overtime. And and none of those equal the same amount every single pay period. So there's a worksheet that we do, but you're getting into an averaging of that income. Now, typically, we're going to need at least 6 months of history of consistent and reliable income in order to show what that averaging of income is. So some people that are going, I have a client right now, went from a preschool teacher to a pest technician, like someone goes out and sprays for pests. Well, the issue is that it's a new job and she's not working a standard 40 hours. So we told her we need to talk in 6 months so we can show a history of what are those hours going to work. Okay, so that's called variable income. And then over time, bonus, commissions, we're typically going to have to show at least a 2-year history. That's going to be average. Again, like I said earlier, you're never consistent on your overtime. Okay, so that's going to be average. Now, these are general. There's always exceptions to those rules. And so we would need to look at each individual and what the criteria is, but these are just kind of the general criteria. So that's how we're going to come up with some of the base income. Okay. Now, I've gone over a lot of stuff. I want to open this up to some questions about your own situation or other things that have popped up that I can identify so that either yourself, your borrowers, anyone else you know might have some specifics about what do we do to make sure that their income works. I will tell you, the best thing to do is to get them in touch with a lender early in the process, provide all of the documentation, and I mean all of it up front so you can sort through what the income is and make sure that you have a successful transaction. So that's kind of what I wanted to say. I'm going to